Hello, everyone. Welcome to another episode of the Eitel Insights podcast. We had a pretty eventful week personally. As everyone noticed, we just recently simultaneously released two podcasts. We have a very good explanation for this. It is summer.
Half good reason at the very least.
Yeah, exactly. It's interesting to note that Dane and I, we went on a little boys trip out to Shuswap, and we had a great time on a houseboat for a few days over the August long weekend. Shout out to the Twin Anchors Boating Company. What'd you think of the stars and the change of scenery?
You know what? It was really interesting. As probably our audience knows, I love data, and some new data was coming out, so I actually had to quickly check that right before we took off to hit the boat. Ended up bringing the laptop on the boat, but fortunately we didn't have any internet connection, so I couldn't really do too much work. But yeah, no, the trip was fantastic. It was great to see Shuswap get out of the city and the hubbub of all that. It was a good chance to relax and get some sun, and like you say, the stars. Wow. I mean, the city, the light pollution here, it's quite something else. I mean, it was good to get out of the city for a little while, put it that way. Also happy to be back and back at work here.
Yeah, exactly. I kind of forgot that stars were even a thing.
Kind of, right? Yeah. Well, you live in the heart of downtown, so that makes a bit more sense.
Exactly. Like, stars are a bizarre phenomenon that I always sort of knew existed, but I thought it was just a mythological thing, like a centaur or a unicorn. But when we're out there, we actually saw it. But I think it was productive as well. We had a lot of philosophical arguments about technical analyses and various business directions we can take with Eitel Insights podcast. So,
for sure.
And the business itself. So I think from an abstract standpoint, it was a very productive trip. It was good to rewind and recharge, and we're ready to go again.
Ready to go.
Yeah,
we got some new data today.
Yeah,
or some new data to release at the very least, in our analytical interpretation of said data.
Yep, exactly. So if you haven't listened to the other podcast that we just recently released about the various markets in Canada other than Vancouver, feel free to check that one out first, or of course take a look at that one after this. But
yeah, just briefly on that, that's capturing about Fort McMurray and Halifax, and then an update about the Toronto market as well. And we'll actually touch on Toronto just before we finish off here today again. We got some new data, as we say.
For sure. So the big news is new data has come out about Vancouver, and we pride ourselves in being as accurate in our prognostications as possible, but naturally we're playing a very complicated game here, and that's the value that Eitel Insights provides. So with Vancouver, we did actually talk about this in the podcast, and everything's about probabilities, right? With technical analyses, we do make forecasts about where the market's heading, but it's all fundamentally rooted in analyses. So on the upside, we've been right, almost every single time. At the same time, we do provide a caveat and say, these are the downside risks. So we got a little bit of surprising news, even though we did touch on the possibility before. So Dane, talk to me a little bit about what's happened with the detached market and how it conforms to the various kind of directions that we've set forth here.
Sure. Yeah. So, I mean, as far as, you kind of say that we're bang on. I mean, we are bang on in our forecast of the trajectory of the market. Month out price points, I mean, that now we're getting into the nitty gritty where no other analysts will even attempt to, let alone kind of show which trend points that we're at. Usual analysts or economists will just say, well, it seems, the Vancouver market is slugging along. Well, what does that mean? Are we going higher or are we going lower? But yeah, month out price points. This one was a bit of a shocker. The actual sale price here in July was $1,494,000. I was actually looking for something a little bit above $1,510,000. So basically what that kind of shows or preludes to is the next quarter is very interesting. Whereas I kind of thought that we'd be in a tight range, which we still are, but slightly above where we currently are. Like I say, maybe a $1,515,000, $1,520,000, as opposed to the $1,494,000. So that means that we've actually broken again out of the 10-year cycle. We can snap back into it. Simultaneously, we're at the low end of our downtrend. So everything still kind of points towards a negative market. We're just expecting a little bit more solidarity as we still go lower longer, right? So that's one thing to keep in mind, just as a general term. Even when you hear, month over month, we might be expecting it up. it's not a long-term up. Like, we're not expecting the market to find its base here. We might see a little bit more stableness, stability in terms of prices and maybe even in terms of sales, but we're still looking for the average sale price of the Greater Vancouver detached market to go lower longer until approximately 2021. So, it's not like the stock market where you can buy and sell that particular house in 1 month opposed to the next. Yeah. So it is about the long-term plan. Why we actually, so we'll get into the sales numbers if you don't mind.
Sure,
hey?
Yeah.
All right.
Let's do it. Yeah.
All right. So the sales numbers, and a lot of media kind of put a quick snapshot out there. I mean, on the long weekend too, so probably not too many people actually paid attention to it, but it showed that July was good for sales, and they used some crazy chart that kind of shows over the last negative years of sales how this is a positive. Well, there was 852 detached properties sold in the month of July. However, there's 6,370 properties available, right? So, I mean, the inventory is still ever progressing. And actually, the average since 2005 is 5,200 listings, right? So, we're above the average in listings and ever growing. And for sales, the average is 1,070, and we're only at 852. So, we're below the averages on the sales side. So, to say that this is a market change is kind of an incorrect statement, a little bit maybe wishful thinking. As we know, media likes to take both sides, right? They'll really do a month of, it's doom and gloom, and then, okay, we got rainbow and puppies everywhere, right? So yeah. we are fairly consistent in the fact that the detached market on an average basis is going lower. I'll point out some markets are down as far as 25% in some areas, right? So the average sale price is currently down 17%. Why we're seeing a little bit of a bump in sales, and I was anticipating a little bit more of a bump in sale prices, is because we're starting to mitigate that stress test effect. So there is actually a segment of the market that has been on bated breath, waiting to come back into the market or actually purchase because they were victims of this stress test, right? Yeah. So those couples that maybe had a new child and they just can't live in the townhouse or the condo anymore, there's still pent up demand to get into that detached. So now that we're kind of approximating closeness to the 20% mitigation level, I was expecting to see a little bit more of a demand. I still think that will come here over the next quarter or so. I'm not expecting a huge leg lower, but it's still possible. I mean, the market makes the decision, right? The overall psychology. Yeah. The detached market isn't all rosy. And to be truthful, we could have actually seen 1,100 detached properties sold this month and still been firmly in a downtrend. So 852 is really kind of the middle of the conservative downtrend, as with our ardent listeners will know. In May we broke out of the falling knife downtrend, but we're still very much so in our prolonged downtrend, and so that doesn't really lead me to change any of our prognostications of going lower over the longer term in course in time. However, we're still kind of expecting or anticipating a little bit of stabilization to the detached market just because of that pent up demand. And, people move for a variety of reasons. It's not necessarily just technical or investors. And I think that's who we're really dealing with in this new marketplace. Investors seem to have gone for greener pastures, maybe Halifax. So the local market is still really prevalent here. And I think that we'll see a little bit of a bid as we get closer to the full 20% mitigation, but then ultimately lower longer. If we continue to go lower and test again 1.4 million or so, which is the lowest end, that probably would have happened with not so much over governmentization and overreaction as to what real estate markets do. If we continue on this kind of underwhelming trend, 1.225 as an average sale price is a real life possibility, and that's a 31% correction from the May 2017 price of 1,830,000.
Right. So I think that's an important trend. We've naturally broken this micro trend that we initially expected, and we're a little bit lower than the 1.51 that could have happened, and we're at 1.49. So what's the implication for the seller? So we've kind of encouraged that if you're looking to sell in the short term, now might be a good time. Does that still hold?
It's still sooner the better, right? I meet with clients all the time for their real estate purposes. I mean, it's the analytical charting that we offer them, and then we set them up with a good realtor in their area or whatever suits them best. If they have their own, God bless it, I mean, but we really help them into what are you going to get today? What's the anticipated price of today's sale price versus a year from now versus 2 years from now? And I haven't done a chart or a perspective for a client yet where it says, you know what, in 2 years, you'll be doing better than today, so I can advise to hold off for 2 years. That will be coming, of course, right? As we get closer to the bottom, then we start to see some projections that are through the tunnel. Right now, we're still very much at a dark point as far as the light at the end of the tunnel is concerned. We are going lower longer. I mean, I will say, though, at the same point, we are down 17%. The probability of us going lower than 31% isn't a likelihood. Right. So just on those numbers, we're a little bit more than halfway down, right? So, I mean, you can buy with a 10-year projection. Mm-hmm. However, there's nothing wrong with buying with a 10-year projection as these markets continue to go lower, because that 10-year projection will just be that much better as far as equity in your pocket. Mm-hmm. Those people that have circumstances where it necessitates a move, of course. I mean, we can still guide you into the areas that are maybe a little bit lower and we'll see a rebound closer. That's something that you might think about. Or if you're thinking about a purchase, it's never a bad idea to just run it past us and say, hey, listen, how much more is it going to lose over the next 6 months, a year, or 2 years? Because maybe I can hold off for the next 6 months, even though my price point is mitigated and I can enter. How much more is there expected? Some areas it might not be much, and you might as well go ahead and purchase today. Some areas there's quite a bit more room to go, and we would advise maybe holding off as long as humanly possible.
Yeah, and exactly that. To that point, just a little bit of a plug here. So if you do want to get individual advice for your investment needs or even kind of your own real estate purchasing needs, Eitel Insights does offer consulting services. So feel free to reach out at eitelinsights.com or Dane at eitelinsights.com. And we do offer that as a service. So, of course, you can continue to purchase our one-off reports that have been very popular, particularly as we've started this podcast. And you'll get analyses based on the latest data that's been released. So you can start off there. You can start off with one of our reports. That's the most affordable option. But if you do need customized advice, reach out to Dane, and you can get a little bit of a discussion on what kind of, within our array of services, what might be the best suited for your what you're trying to do. Yeah. Dane, let's move now to the condo market. So we got a little bit of a surprise on the detached market. Are we seeing the same trend as far as average sale prices in the condo market?
No, actually, as kind of the opposite as to where the detached is at the lowest point in the downward trajectory. Actually, the condo market is kind of testing the upward point of the downtrend in that individual chart, which makes sense. I mean, we've kind of tested here as a psychological middle bottom, the price around $635,000. Ultimately, that will not hold. However, the market seems to be based out here a little bit at a 13% downtrend after basically a quarter of barely any movement. Currently, the purchase price or the sale price in July was $656,000. And once again, that puts us right up against the upwardmost of the downtrend line. Our best case scenario for sellers out there, on an average sale price, you might see an increase from $656 where it is today to $675 at best. So there's really not too much rays of sunshine or puppies for the sellers. We believe we're probably closer to seeing a $635 price, which is the next yellow line, kind of cautionary tale, before we get into the next psychological value will be at $584, and then probably halting around $525. So I mean, where we are now at $630 or $656 isn't a bad place to sell. Buyers, however, because of that stress test, they're nowhere near mitigation, right? So we're only 13% down. We're looking for a 20% down to even start to mitigate that. Plus, when we are at that price point, there's probably a lot more negative sentiment towards the real estate market. Right now, it's kind of, you got two sides, right? And I think we've pretty clearly chosen which side we're on, if not leading that side, saying that we're going lower longer in both markets. So the condo market does naturally lag the detached market to some degree, 6 months to a year on average. Yeah. So I would expect the condo market, to be down at the very least 30% to that 525 mark, early 2021, as opposed to, and last to that point throughout 2022. Now, there's the fundamental reasons as to how we get there, which is, the sales, the inventory and the sales, right? Supply, demand. So just kind of sticking with our theme of how the month was versus how much better it could have been and still been in a negative position, right? So the total amount of condo listings was actually at 5,588. That's above the average since 2005 of 5,250, right? So we're above that average. For sales, the average since that period of time has basically been right around 1,500. Currently, we only saw 1,245, right? So that's not exactly the great indicator. So the inventory is above the average. The sales are below the average. The sales in the condo market could have seen sales of 1,600. So an additional, 350.
We'd still be within our range. Yeah.
Exactly. We'd still be within the downtrend, right? So not too much positive news in the condo market. We're expecting those prices to go lower longer as well, and probably a little bit more in a rapid pace here over the next year or so, as opposed to the detached market. I'm still believing that we're going to see a bit of a base here temporarily in the detached market. I don't believe we're going below 1.4 or 1.48 necessarily anytime soon. However, the market makes their decisions. If we do that, we're testing 1.225, absolutely no doubt about it. And we've mentioned that on podcast previous as a real life possibility. However, with the data that's coming out, it's seeming more and more likely as we go. Now, it takes a month to get data. So, as data comes out, as our audience knows, I get excited, right? It's an interesting data point. Next month will be a little bit clearer. The month after that will be a little bit clearer still. And then we'll see exactly where we are within this downtrend of both the condo but more specifically, the detached market, as it does lead the condo market.
Okay, sounds good. So we wanted this particular episode to be a Vancouver-centric episode that looks at the new data that's come up. But I think it sort of behooves us to talk about some interesting developments, particularly as an extension of the last podcast that we just released as well. So before we head out here, I just quickly want to touch on Toronto, because Toronto's had new data as well. Toronto's been a little bit of a generally surprising move in that it's held firm. It's held more firm than most people had thought it would. So with new data that's come out, I think that we've seen a little bit of a iconoclastic move in the Toronto market. So what happened in Toronto last month, and why is it surprising?
Well, not surprising. I guess the months previous were surprising as to
right. So,
now it's starting to come our way. We will put the chart up here, as we've probably done here for the last few charts. Basically, inside of a chart, you can tell a story, if you will, right, of each individual chart. The kind of way I see the Toronto chart, you'll see on your screen the growth cycle of the green ascending line. The data point where it's at right now is almost like your kid brother trying to hang out with the older brother. Earlier on in the phase, during 2016, the kid brother got a little bit too big for his britches and shot up right past that older brother's standpoint. So it shot up to all-time highs of 920 some odd thousand, and now it's back down. It tried recently over the last quarter or so to hang out with the older brother again. Ultimately, he's been shunned. So, between June and July, we saw roughly a $25,000 price loss. It's not the sky's falling or any of that. However, it does confirm that it can't get back into that growth cycle, which was propelling the market higher. Inclusive on the chart, you'll see a black uptrend, which it currently still is, and still above the green line. We're expecting it to test the lower end of that black trend, and then ultimately back into basically the uptrend that was established in 2010. So we are seeing that market start to get some higher lows as opposed to that stableness. Now, again, this is an early indicator. Eitel Insights prides itself on giving you early indication. In about a year or so from now, everyone will say, well, Toronto was too frothy. No, we said it in January. It seemed to be a bit frothy. Were we incorrect in the fact that it didn't fall off right away in the first two quarters? Yes, but a month after the first two quarters isn't the worst thing in the world either. Sure. And that's that challenge of being correct. But is it to the decimal point? Probably not to the 100th of a second. But with the full rounded off numbers as the grand scheme of things goes, our clients are extremely excited about the insights that we can offer them, so they can make the best move. We were meeting with clients, and here's your market. This property value on average is probably going to lose, X percent over the next year or so. So you can choose to list today or next year, whatever fits your circumstances better.
Yeah.
If that X number is a double-digit percentage loss, their personal situation might change because that's some real significant dollar values. If it's, in the 6 to 7%, now, it's really about your personal circumstances. But us enabling them to know that there is some help out there of how much worse or how much better it could get depending on which side of the fence you are and whether it's a purchase or a sale. Yeah. And to reiterate your point, our entry level reports fairly cheap in the grand scheme of things as opposed to a purchase price of a condo or a detached properties for sure, right? Yeah. So we're doing a service. The clients and the public is really being warm reception of us. Yeah. So we hope that continues, and we hope that we continue to be excited with new data comes out, which we always are.
Yeah, exactly. And I think that's a good point too, right? With predictive analytics in any industry, it's all a spectrum of granularity, right? So to take a simple example, anyone can say over 100 years, a house is going to go up in value or land's going to go up in value, right? But
that's Willie Devane, the old Fox Channel
that's
quote,
right?
Yeah. So
yeah, exactly, right? And then, but on a minute-to-minute or an hour-to-hour basis, it's nearly there's too much entropy or there's too much randomness. It's very difficult to predict on that. But it's all about where you land on the spectrum. And I think what's unique about Eitel Insights is we've kind of come more towards the bottom end of the spectrum than anyone else has. So we're not going minute-to-minute or hour-to-hour, but we're so much ahead of the curve as far as the general media goes, and your typical traditional media will say where the markets are heading. So I think that's a very important service that Eitel Insights provides, especially for the typical consumer who needs to make these granular decisions for their lives. Yeah.
And just one point, we don't mean to blast the media because we are friends of the media. I am featured every once in a while on some Vancouver outlets and hopefully going on a national stage here in the not too distant future, especially as the podcast continues to grow. Yeah. But they have two sides of the coin, right? They do have advertisers that they do answer to, right?
Of course.
If you have a real estate group that pays a substantial amount of your advertising, you're saying real estate's going down, they don't necessarily want that guest on minute by minute, hour by hour. So we are on, infrequently throughout the media, and probably as this market gets closer to a bottom and we start to share some progressive news or positive news, as the rest of the analytics, because they are so far behind in the projections, they're saying it's going to get worse before it gets better, and we're saying actually no, this looks like it's a bottom.
Right.
The exact opposite, the antithesis of the top, right? So it all comes full circle. Everything really does have cycles to it, and that's one of the reasons Eitel Insights exists, is because things do have cycles.
Yeah, for sure. And there's no slight against the media. They kind of their modus operandi is to report on polarizing headlines, right?
Absolutely.
So
we are polarizing, and who else? And the other people they cover are polarizing as well.
Yeah,
we just say, choose the history and choose the track record a little bit, because we do exist now, right?
Yeah.
The interesting thing is nobody really would stick their neck out the way we do, and we are kind of the first to do it successfully. Yeah. Pinpoint successfully time and time again. So it's exciting. It's a very exciting time.
For sure. So with that, we'll wrap it up. Thanks again for joining the Eitel Insights podcast. We had a lot of fun doing this. And again, you'll see that we've recently released 2 simultaneously. So hopefully the wait was worth it. And we'll see you on the next one.
All right, guys. Thanks.